Li Lu is often called the Chinese Warren Buffett, and for a good reason. He is famously known as the only money manager that Charlie Munger has publicly endorsed. Li Lu is the founder of Himalaya Capital, which manages billions of dollars in assets today. Since its inception, Himalaya Capital has delivered an average annual return of over 30%, which is nothing short of amazing. Li Lu's moves, disclosed in his latest 13F filing, offer unique insights for investors seeking long-term growth. This is my fourth video in the Super Investor Portfolio series, so consider subscribing to not miss out on future deep dives into Super Investor portfolios. In this video, I will dive into Li Lu's portfolio, explore each of his holdings, and reveal the one Li Lu stock I believe could join my portfolio at its current valuation. Stay tuned to find out which one. Li Lu's portfolio showcases a mix of high-quality companies with a strong focus on long-term value. His smallest position, accounting for a little over 1% of his portfolio, is in Sable Offshore Corp, a company involved in the offshore oil and gas exploration sector. Li Lu has invested almost 3% of his portfolio into Apple, a global leader in technology known for its consumer electronics and software services. Occidental Petroleum accounts for 3% of his portfolio. The company is a major player in the oil and gas industry, with a strong preference in exploration and production. A bit over 9% of Li Lu's portfolio is invested in East West Bancorp, a leading financial services company primarily focusing on banking products and services for individuals and businesses. One of Li Lu's most notable investments is in Berkshire Hathaway, which makes up over 16% of his portfolio. The diversified holding company led by Warren Buffett has proven to be a solid long-term investment with a focus on acquiring high-quality businesses. The second largest position, Bank of America, accounts for a significant 29% of his portfolio. As one of the largest banks in the US, it benefits from a broad range of financial services, including banking, investment, and wealth management. Finally, Alphabet, the parent company of Google, holds a dominant share of Li Lu's portfolio. Combining both classes of stock, they account for over 37% of his portfolio. Alphabet continues to thrive as a leader in technology, digital advertising, and various innovating ventures. Now, let's do a quick overview of each of his holdings. The smallest position in Li Lu's portfolio is in Sable Offshore Corp. It's a new position and definitely not a standard one. Originally founded in 2020, the company rebranded in February of 2024, transitioning from a SPAC to a focused offshore oil and gas company. Sable Offshore Corp increased its cash and cash equivalents to $288 million last quarter. The company raised $150 million through a private placement of 7.5 million shares and $72.5 million through public warrant exercises during the quarter. However, there is a big problem. As of yet, the company hasn't been able to report any revenue. While I am sure that Li Lu has a solid reason for this investment, it's not one I would choose as a value investor. Evaluating such a company is too complex for me, and I would personally choose to overlook it. In the last quarter, Li Lu significantly reduced his position in Apple, cutting it by more than half and bringing it down to less than 3% of his portfolio. Apple's business does not need an introduction, so let's go straight to the pros of a company. Apple has created a sticky ecosystem between iPhones, iPads, Macs, and subscription services, creating a strong consumer loyalty which ensures steady revenue. Additionally, over the past decade, Apple's revenue grew by 95%, but its earnings per share increased by 227%, which means that they're able to manage finances exceptionally well, driving significant profitability. Also, Apple continues to reward its shareholders with 12 consecutive years of dividend growth and billions spent on share buybacks. Finally, even without strong revenue growth, Apple's great cash flow allows the company to make strategic financial investments that help to create shareholder value. For concerns, Apple is no longer seeing the high growth rates of over 20%, now reporting sub 10% growth. This slowdown is expected as such huge companies like Apple face challenges sustaining rapid expansion at such a massive scale. But what concerns me the most is the fact that Apple's stock price is high. With a PE ratio of 40 and a forward PE ratio of 34, in my opinion, this makes it expensive relative to its future growth projections. So, to sum up, while Apple remains a strong company, their growth has slowed down significantly, and because of that, I do not think they should be trading at a premium multiple, which makes the company overpriced and could be the reason why Li Lu is trimming his position. With a 3% allocation, Li Lu's third position is in Occidental Petroleum. The company is a major energy player primarily focused on oil and gas exploration, production, and innovative carbon capture technology. The company is planning strong and diversified growth. Their Crown Rock acquisition is expected to add $1 billion in annual free cash flow at current oil prices. Also, they're planning over $1 billion of additional cash flow from various non-oil initiatives by the year 2027. Berkshire Hathaway, led by Warren Buffett, has consistently increased its stake in Occidental. It has invested $12.5 billion, totaling more than 28% of Occidental's outstanding shares. Buffett's average cost basis is around $53 per share, while the stock currently trades at around $50, signaling possible undervaluation. Finally, Occidental is investing heavily into carbon capture and storage technology, including constructing the world's largest direct air capture facility. They believe this technology could eventually rival their oil and gas revenue. While all of these things sound really promising, there are some potential concerns with Occidental as well. Their earnings and cash flow are really sensitive to crude oil price fluctuations. For example, in its latest quarter, oil prices caused its pre-tax income from oil and gas to drop by $400 million. Additionally, although Occidental plans to retire $3.7 million in debt by the year 2026, its current debt levels still present a risk, especially if cash flow becomes constrained. Finally, oil stocks face criticism and regulations due to their environmental impact. While Occidental is investing into carbon capture and storage technology to address this, these efforts are still in early stages and carry execution risks. The technology remains speculative and unproven on scale. Because of that, returns from this segment may take years to materialize. In conclusion, looking at all of these facts, Occidental is definitely an interesting company with a lot of potential. In my opinion, it's definitely worth to have a deeper look into this position. East West Bancorp is a California-based commercial bank that takes up around 9% of Li Lu's portfolio. The bank has an efficiency ratio of 34%, significantly better than the banking industry's average of 65%. This indicates that East West has a superior cost management and value generation. Additionally, the stock trades at a forward PE ratio of 11.5 and a price-to-book value of 1.7. which is below or at par with peers, despite superior profitability and efficiency metrics. When it comes to concerns, a 63% increase in interest expenses caused net income to decline by 10% in the first half of 2024, even despite growth in interest and non-interest income. Also, 70% of the commercial real estate loan portfolio is concentrated in California, a state that has one of the highest unemployment rates. This adds exposure to regional economic risks. In conclusion, while East West seems to have an edge to its peers, I am not too fond of banking stocks, and I can't say I would want to make this investment myself. Ran by the legendary investor Warren Buffett, Berkshire Hathaway is the crown jewel of value investing. A company that has demonstrated the power of disciplined long-term compounding for decades, takes up over 16% of Lilu's portfolio. It would require an entire video to fully review this vast empire. But here are the highlights why this company stands out to me. Berkshire has many strengths that make it a unique and reliable investment, such as strong earnings growth and a really well-diversified portfolio, which naturally means low risk. But there are two key pros that stand out to me. First of all, Berkshire currently holds an impressive $300 billion in cash, much of which is invested in treasuries. This cash pile offers incredible flexibility. It can be deployed during a market downturn to acquire high-return assets at a bargain price. Additionally, over the past 2 decades, Berkshire's earnings have grown at an average annual rate of 9%. This steady growth demonstrates the company's ability to generate consistent long-term returns, a hallmark for Buffett's value investing philosophy. When it comes to potential concerns, one commonly discussed issue is Buffett's age. At 93, some wonder about the company's future leadership. However, I don't see this as a significant problem. Berkshire has a strong team surrounding Buffett, all deeply rooted in value investing philosophy, ensuring the company remains in capable hands. Despite that, there is one key issue I see with the company. At $1 trillion market cap, they're currently trading at around 23 PE, when the historical average is around 15, which means that if the multiple would compress to its historical average or even lower, the valuation could easily follow. To sum up, Berkshire is a reliable long-term investment suitable for conservative portfolios. While returns may not match its past highs, its low risk and compounding potential make it a solid choice for value investors. In my opinion, at this point, it would be a better investment than the S&P 500. Bank of America, one of the largest financial institutions in the world, takes up almost 30% of Lilu's portfolio. The company has consistently demonstrated its ability to adapt to an evolving financial landscape. So why Bank of America could be a good investment? First of all, they have achieved higher average loans, climbing deposits, and record customer investment asset balances. Also, Bank of America is trading at a price-to-book ratio of 1.3. The stock remains below its historical peak, suggesting room for further valuation expansion if economic growth continues. For concerns, at current levels, the stock may face headwinds if growth slows or economic conditions worsen, potentially limiting upside. Additionally, the bank set aside $1.3 billion last quarter for potential loan losses. A big increase in this amount could mean more borrowers are defaulting, which could hurt profits. Finally, the growing pressure of fintech companies poses a long-term challenge to traditional banks. In summary, Bank of America remains a solid choice for investors confident in steady economic growth and the bank's ability to sustain its competitive edge. However, I am not a big fan of banking companies, and I can't say I would like to own this company at this point. Taking the crown, Alphabet is the largest holding in Lilu's portfolio. With more than a third of his portfolio, the parent company of Google is a global technology leader that does not need an introduction. Alphabet's latest quarter revenue increased by 15% year over year, indicating strong business performance. Additionally, the company's investments in AI, cloud computing, and other ventures provide multiple growth avenues. Also, Alphabet's strong cash flows enable continued investments in innovation for further growth. Adding to that, Google maintains a dominant position in search and online advertising, contributing significantly to Alphabet's revenue. Finally, while their PE ratio is relatively high at around 25, it is still discounted compared to other established tech giants like Meta at 28, Microsoft at 35, and Apple at 40. For concerns, Alphabet faces increasing regulatory challenges related to antitrust concerns, data privacy, and market dominance. Also, despite diversification efforts, a large portion of Alphabet's revenue still comes from advertising, making it vulnerable to ad market downturns. Finally, growing competition from Microsoft and Amazon on cloud services and AI tools like ChatGPT for search pose significant threats. To sum up, I personally own the stock at a much lower valuation than its current price, and I still like it. However, while I believe Alphabet should outperform the market in the near future, I would prefer to see its valuation drop a bit further to add more. In conclusion, Li Lu's Himalaya Capital Management has a highly concentrated, well-diverse portfolio. Spanning across multiple different sectors, the portfolio reveals a preference for quality and stability with selective adjustments that demonstrate a disciplined value investing approach in a dynamic market environment. So, after analyzing all of these stocks, it's time to reveal which position I would add to my portfolio at its current price. Basically, it was a strong competition between three stocks: Alphabet, Berkshire Hathaway, and Occidental Petroleum. In my opinion, both Alphabet and Berkshire Hathaway should outperform the market in the upcoming future. However, the stock I picked and liked the most was Occidental Petroleum. Its diversified portfolio and strategic investments for additional income truly captured my attention. But what do you think? Do you agree with me? Comment down below which Li Lu stock would you pick. If you enjoyed the video, consider subscribing and clicking the like button, as it does help to grow my channel. And as always guys, thank you for watching, and I hope to see you in the next one. Bye.